Good evening, everyone. Today, this is the follow-up video that I promised about how I decide generally between which contract to select. Do I pick the safe contract or do I pick the very safe contract? It can vary, but let me show you why I picked the very safe contract in this case. So if you haven't watched my previous video, I do recommend watching it. It just talks about how I've recently sold 190 covered calls on SoFi for August 2nd, so a 2-week expiration. Each one would give me a profit of 13 cents. And it's at the $6.50 strike price. So that means as long as SoFi, you can see right now it's sitting at around 740-ish. If it were to drop down to 650, I would still collect 13 cents worth of premium. Now that doesn't sound like a lot, but it's roughly about 3.5% worth of profit within 2 weeks, which is pretty significant depending on how much you invest. And so in my case, since it's about 190 contracts, that would be around roughly $2,500 less the interest that I would have to pay because I did leverage myself. Let's call it about a little over 2K. But let's go ahead and go through this example and let's see how it is that I make the decisions. I try to make a chart just to make it as simple as possible, so that it's very easy to understand. So the stock is SoFi. And let's say, and by the way, this is not financial advice, this is not what I'm recommending. This is just the way I look at it and the way I tend to make my decisions. Just, I hope you might, maybe you take a look at this and you realize, hey, it's kind of interesting investing. So if that it interests you, that's good. And there's always a lot of resources out there to learn more about it and then like get involved in your investing journey. So that said, here's the stock SoFi. I selected 2 weeks worth of expiration. So the reason why these contracts are priced a little bit higher than normal is because earnings happens on the 30th. So before August 2nd, and because it captures earnings, there is a higher premium on these calls that I'm selling. So as a result, this is going to be a little bit higher than normal. You can't expect on SoFi to get this safe of a contract and get 3.5%, but nonetheless, let's talk about it. So in 2 weeks, we're going to assume that you sold, in my case, 140 covered calls. I know I mentioned I did 190, but the reason why I said 140, it's just so that I can make these two positions the same. I'm assuming I purchased about $100,000 worth of SoFi, and then I sold covered calls. So that would be enough for 140, 14,000 shares, which would be 140 covered calls either at this strike price or at this strike price. Obviously, you can leverage yourself even further and then sell more, which is what I did in my case. But let's just assume right now, just to make things equal, 140 covered calls. So we're going to talk about the two. So here we have the price at expiration on the left-hand side. And then here we are going to talk about the two different types of contracts and what kind of profit you can expect, depending on what the price is at expiration. So for now, right, the price is around 750. So that's what we're at right now. Let's talk about these two contracts. So if you were to sell it at a higher price, the covered call at the $7 strike price, which is still a pretty safe contract given that the stock price is 740. So it would have to drop another 40 cents and you would still be in the money. You would still be able to receive the full amount of premium. You could get your shares exercised, you would still be profitable. And you would receive 30 cents per 30 cents or $30 per contract, and $30 per 140 contracts. That's $4,200 profit. So essentially, as long as you stay above 7, you get $4,200. And then in this case, in the very safe contract, you get paid less, but you're in a safer position. And we're going to see exactly what that means. But since you sold 140 and you're getting $13 per contract, that's a maximum of roughly $1,800 per contract. So let's look at the two, $4,200 versus $1,800. So some might look at that and might say, why not just take the one with more profit, right? That seems like an obvious choice. Well, let's go through it. Let's just imagine the scenarios. What could happen in 2 weeks? Well, let's just think about that for a second. So let's just imagine in 2 weeks, we let these expire, right? Let's just imagine we let these expire on August 2nd, on Friday, sometime when market closes. What could happen is the following. Let's say the price goes to the moon, like a lot of people talk about with stocks. I always think that's a funny expression, but let's just say it goes to $1 million per share, or just any price that's really above the current price. So it doesn't matter if it's $8, $9, in this case, $1 million per share, whatever it is. This is just more for fun. Then because you sold covered calls, you max out the amount that you could receive. So if you did it with the $7 strike price, you would get $4,200. Now, if you did it with the 650 strike price, you would get $1,800. So if the price were to go up, you would make more money if you had sold the $7 strike price, right? This one's pretty straightforward. What if the price were to stay the same at around 750, even 740? So this could be written at 740, it would still hold true. Well, what profit would you receive? So in this case, you would still receive $4,200 profit. Nice. So in this case, it's still better compared to the $1,800 profit. Okay, so far we're seeing cases where the $7 strike is kind of better, right? Because you're making more money, you're still kind of safe. What if we drop down to $7? If we drop down to $7, so here there was a price drop. In this case, you would still make $4,200. You would still collect the full premium. You would get your shares exercised, right? And that's a good day. You made $4,200. If not, what would happen, or what would also happen for this very safe contract is you would still make the $1,800. So at this point, all these three scenarios, and so far that we discussed are all these three scenarios that we discussed. If it goes up, it stays the same price, or if it drops down like around 40 to 50 cents, you're still making more money on the $7 strike price. So, right. So that's something to consider. You might already say, I don't need to hear anymore. Let me do that. That's what we'll go with. Yeah, you might consider that. Once again, not financial advice, but this is just what someone might hear just right away. But let's consider scenarios where things go bad. And I know it's not always nice to think about things going wrong. But just last week, the stock was at its 52-week low. It was at around $6.20. So it's not out of the question, or I don't know if it was last week or the week prior, it was down to $6.20. So it's not unrealistic to say that it can't go back there. I'm not saying that it will. I'm not advocating that it should. I'm just saying that it's within the realm of possibility that it can go significantly down or even further, right? We never know what's going to happen with the market. Anyone tries to tell you they'll know exactly what will happen, they're lying to you. And or if they really want to say that, then have them write up a contract that will guarantee that you will make profit, and see how fast they kind of backtrack or won't be won't be kind of willing to go into that contract. That said, let's go to the scenario where this were to drop to 670. Now I specifically picked 670 because this is 30 cents less than the $7 strike price. So this eats up all the premium. So at this point, you would keep all your shares for the $7 strike price, but it's effectively you would break even. You didn't get any profit, you didn't get any loss, you just broke even. But the very safe contract, I still made $1,800. So now you're starting to see where this is kind of nice, right? The 670 price, if it were to go down, which SoFi tends to go down after earnings just as of recently, just generally speaking, it's unfortunate. It's kind of been a little bit of a trend. I hope that that's not the case. I hope that it is able to be stable around maybe like the $7 price, which I think would be appropriate. But let's say it were to go down. In this case, the very safe contract would be worthwhile, because in this case, I would have spent 2 weeks waiting and I would have made $0. I would have just broke even. So that's not great. Now let's say we get into a very sad scenario where the stock price were to drop to 650. So if the stock price were to drop to 650, then at this point, for the very safe contract, what's really nice is I'm still making $1,800. I'm still making the full profit. I get my shares called away. I just get to keep the premium. Everything's nice. Life is pretty nice. But in the $7 strike price, I still get to keep my shares, but I'm down 20 cents because my break even was 670. I lost 20 cents for 140 shares. So 20 times 140, you lost $2,800. So you're down $2,800 from your position, assuming that you bought 140, so essentially 14,000 shares worth of SoFi. So you're down significantly, almost $3,000. That's not a great scenario. Now let's consider the scenario where you get down, very shocking, you get down to 637. If it were to get down to 637, now on the $7 strike price, you've lost $4,600. You've lost quite significantly. So if it were to get anywhere close to what its price was, not just more than, and actually let me prove that to you. Let me go to SoFi. Let me go to the past month. It wasn't since, this isn't surprising. This is July 9th, right? So this wasn't that long ago. This was less than 2 weeks ago that the price was around there. So it's not unreasonable to say that it can get to its price that was around 2 weeks ago. And we could, or the people who are going into this position could have lost in this scenario, right? In this exact scenario, would have lost $4,600. However, given that I went with the very safe contracts, at that point I would break even at 637. Now, anywhere below 637, this very safe position would start to lose money. Right? This very safe position would then start to lose money. For every dollar, it would lose $140. Very similar to here. But look how far I had to drop before I started losing money. So that's why it might sound strange that I went with this this very safe contract, the $6.50 strike price, where I sold my covered calls. Selling in the money, you get less of a reward, but at the same time, you get more of an insurance, more of a protection if things go wrong. And say, for example, if things did go really wrong, because in the case of SoFi, earnings, they tend to go down for, for whatever reason, it just tends to go up, and then afterwards just tends to go right back down right after earnings. If that is the case, then I'm protected. And then afterwards, I'm back in, right? Let's say now I own the shares at 637. Let's say it does get down to 637. Well, I still have my 52K. I have my my original amount that I invested. I have all my shares, all those shares, I would still have them. And then I would be able to rent out those 140 contracts again for the next few weeks, next few months, next year. And I would be able to be in a much better position. And I wouldn't be at this position where I'm almost down $4,600. So I hope that kind of talks about why I prefer these safer contracts. I didn't put the $7.50 strike price because that assumes that the strike price has to stay the same in order for me to make money. Like you saw, I want some protection in the sense that, like, even if it goes down, I'll make the full amount of money. And in this case, if it goes very down, I'll still make quite a like a 3.5%, which is pretty significant. I like to think profit. So while it is a little bit less than half of what this would be, it's around 40% of what the $7 strike price would be. It's, once again, it's not out of the question that SoFi could go back down to near 52-week lows, or low $6. And once again, I'm not saying that, because I know there's a lot of SoFi bulls that might watch this. I'm not saying it should. I'm not saying that it's going to. I'm just saying that if it's within the realm of possibility, and if that were to happen, it's nice to have insurance. So I hope that this makes sense as far as my approach to kind of viewing the contracts and why I decided to pick the one that I did. And yeah, so I hope that makes sense. If you're looking for more kind of stock entertainment content, and you're always welcome to watch. I'll be making more videos, but as you can see, selling covered calls, not too exciting, in the sense that I just kind of have to wait until after earnings for the price to either go up, stay the same, go down, whatever it's going to do. And then from there, I can evaluate what I'm going to do, whether I can maybe just let it expire, whether I can buy back the contracts for super cheap if the price is still high. There's just quite a bit of options, and then I'll make videos on what it is that I'll ultimately do. So that said, thank you. I hope you have a wonderful night, and I will see you soon.